Hello and welcome back to KD's Businesses. Michael Lapede here, going to talk to you on a video about how small businesses can effectively forecast their cash flow issues. Because let's be honest, a lot of times you don't know about the issue till it comes. Kind of like in the last video, we talked about those warning signs, but this is now talking about how we project ahead. So it's a good tailor on that last video. One of the best ways to avoid financial stress of your business is to effectively forecast into the future your cash flow. Forecasting cash flow helps businesses prepare for the worst case scenarios as well as plan ahead. Forecasting cash flow is especially important for businesses that deal with seasonal fluctuations, tax deadlines, and unexpected downturns. Forecasting cash flow is especially important for businesses that deal with various things that are fluctuational, basically, is what we're saying there. Anything that might fluctuate up and down in your business, like your pricing, your seasons, anything like that, it's extremely important. But that being said, it's extremely important for every business to forecast their finances and forecast their cash flow. Here are some ways you can do this effectively. Number one, monitor and track your income and expenses regularly. It's important that you record all income sources and your expenses, including your fixed and variable, so know what your fixed and variable, and set an estimated cost and an actual cost to compare. So you're estimating now cost of the future, and then you're comparing the actual. So estimated, actual, and you're comparing the two. So if you're forecasting, say 3 years in advance, each month you're going to want to see how you did compare to that forecast all the way for the next 3 years and going forward, because it's going to roll. And that brings me to make use of rolling forecasts. Create monthly and quarterly cash flow forecasts instead of just annual budgets, and make sure you update these regularly and keep them rolling. So you're always adding another month to them, because they're always going to catch up otherwise, right? Take advantage of availability technology. There's various available technology out there. Cloud-based accounting software. Obviously, some of them, like QuickBooks, if you're on the highest version, and some of the Zero and Wave ones can automate some of your cash flow projections. These can also work with banks and CRA accounts. Now, you have to be doing accrual daily accounting in those to work. So we like softwares like Fathom. That's one of our favorites too as well. And we can forecast balance sheet, income statement, and cash flow in there. Don't forget to include personal taxes in your forecasts. And factor in tax obligations, plan ahead, set aside funds to prevent cash falls at tax time. So you as the business owner, yes, you're of course forecasting the business taxes, that better be in there, but also what about your personal taxes? You make sure your personal taxes are being cared of, because if you as a business owner don't take care of your personal taxes, it will affect the business. Include best and worst case scenarios in your forecast, right? Look for key factors that may affect your cash flow. And really, we're thinking about things like interest rates, exchange rates, supplier costs. Are they going to fluctuate at all? Are things going to fluctuate? Making sure that you manage things regularly and including that best case and worst case scenarios helps a lot. And then manage your accounts payable and receivable property. Obviously, preparing that in your forecasting and monitoring that so it goes in your forecasting, that will tell you timelines. When do you normally collect? So you can see when the cash flow is actually going to come in. When do I pay my bills? How much credit turns do I have? When is the cash flow going out? And build a buffer. Set aside a cash reserve for emergencies, economic downturns, which we talked about in the last videos, especially when your cash flow looks good. Those are the times to sock it away, right? By effectively forecasting cash flow, businesses will be able to prepare and plan for every possible scenario. And in the event of a downturn, they already have set a plan to be able to implement corrective actions as soon as possible. So you have this forecast, and then you can run what-if scenarios. Best case, worst case, what if I do that, what if I do that? You have a very simple tool once you have the main base forecast in place. Like I said, we use Fathom for this, and you can do micro forecasts in there, add them onto the baseline, take them off the baseline. Very powerful tool. And that's about it for this video. If you got any questions, we'd love to hear from you. Post in the comments below and subscribe if you haven't to, and we'll look forward to seeing you in the next video.